Hello and welcome to Hot Commodities. I'm Manisha Gupta and the top headlines on the show are: the Indian rupee hits a fresh two-year lows and closes every day on a two-year low, hits a new low at 65.85. A sharp sell-off in Indian equities also hurt the currency. The pressure on all emerging market currencies intensifies. Investors are fleeing the EM pack, fearing that the fate has turned for the worse following China's devaluation of the yuan. Remember, Kazakhstan's tenge plunged to an incredible 23% yesterday, and today all of emerging market currencies are struggling to trade in positive. And it's because of the currencies as well that the longest losing streak has come in for crude prices since 1986. A sharp drop in Chinese manufacturing data has heightened demand fears. The US crude oil prices are set for an 8th consecutive week of fall, and it's a 6-year lows coming in for that commodity. Well, the analysts have been placing bearish bets on the EM currency pack as China's devaluation of the yuan and investor concerns of a Fed rate hike in offing, along with sharp sell-off across global and domestic equities, has hurt the entire Asian currency pack, which are witnessing the longest losing streak since 2000. We have with us Arvind Narayanan, who's head of sales, treasury and markets at DBS Bank. Also joining us is Jayesh Mehta, who's MD and country treasurer of Bank of America Merrill Lynch. We also are joined by Erlam, who's senior currency analyst at OANDA on the show. Jayesh, hi, let's start with you first. And what a week it has been. Yet another one, a second straight week where we have seen a complete sell-off come in more asset classes. It's more worrying about the way the emerging market currencies are behaving, though.
Yeah, it's definitely, we had a very steady thing going on the currency, and as we were going through the Fed hike, it was not really expected this kind of movements, but then there was some offing for the China devaluation. Nobody knew about the timing, but that's what suddenly happened, and I think at this moment, yes, we are all reeling through it, and I think the world is waiting for if there is further move on China. So I think that's what is the crucial handle right now weighing on people rather than Fed hike. Of course, that will have their own factor and weight as in when we go near the Fed hike date and timings.
Arvind, as Jayesh is pointing out, we were waiting for the US Fed to do something, and the Greece had all the attention, and then China just comes and steals all the limelight.
Yeah, so typical of China, isn't it? One big bang move which happens and suddenly all the attention shifts to China. So the devaluation, yes, wasn't a surprise in itself, but the timing was. What needs to be clearer now is this a one-off adjustment as China is claiming it to be, or do we see prolonged depreciation of the currency? Because anything which is going to be prolonged in this manner will definitely have a larger impact on USD INR as well. Add to this, so today the Fed rate is actually not such a big event going forward. By and large, the data coming out of the US tells us that at best we'll probably have one rate hike by the end of this year, and nothing much. Even if a rate hike happens, I don't think the pace of rate hikes is going to be substantially steep going forward. So to me, the bigger event is going to be how the Chinese devaluation pans out and what's the impact for India.
Sure. Jayesh, there have been lots of reports from the international print as well, and it says what happens in China doesn't stay in China. China sneezes and the world catches a cold. It really is typical the way the emerging market really has been reacting. But what kind of a reaction are you expecting going forward? Would you say that we have perhaps factored in further devaluation, or are we still vulnerable to anything that comes out of that area?
I think we are still vulnerable, and that's what is weighing, right? So if you look at it last couple of days, China has been very stable, but then the rest of the world is reacting, and that's where the confidence is not there, whether it was one-off adjustment which is done, or is there something further coming. And in that situation, what's happening is, even a small demand is actually flaring up the price. So that's what, and that jitters, I think, will stay for some time, because till people get that, okay, there's no further devaluation happening in China, and that is not going to be easy task, because there's no one particular day, today, tomorrow, day after that one can figure it out. There's nothing further happening. So I think this fear will remain prolonged, and to that extent it is little worrisome, I would put it this way.
Craig, getting you in the conversation as well, as we are discussing, it's been 2 weeks now and we still are reeling under the impact or effects of what China has done. What's your sense? How long will it take to stabilize? Another 3 months, 6 months, 12 months? What time period are you working with?
Well, the People's Bank of China is working really hard to try and stabilise the currency. Even now, we saw last week that they directed a large number of the largest state-owned banks to buy the dollar in an attempt to, to sell the dollar in an attempt to actually stabilise the currency. So clearly there are efforts already being made. The question really is what can it do if we continue to see these kinds of market volatility? This volatility we've seen in the Chinese yuan, we've also seen it in the equity markets as well. And the negativity which stems from that really is flowing through to global markets as a whole. So it's a big concern. People's Bank China has a big job on its hands.
Well, absolutely, Craig. And while we were talking about the Indian rupee, and that has also seen an impact, but if you look at the other emerging market currencies, well, there have been double-digit decliners as well. Take a look at a ruble or a ringgit or a rial. I mean, we've seen very sharp declines coming in for that one, 17% to 30% down for 2015 as of now. What's your sense? Are we looking at further declines for all of these currencies?
Absolutely. We haven't even seen the Fed rate hike yet that people have been fearing, that have been steering a large number of these declines. I think things like the Turkish lira are very susceptible to further declines. It's all about really the state of the economy, and really Turkey is really suffering. It's got lower growth, high inflation, they've got a large current account deficit, they've got large dollar denominated debt. So you look at countries like this who are very susceptible to this Fed rate hike, and so really there is a lot more concern to come for these emerging market currencies.
Craig, what's your sense? Where is a major pain going to be as we go ahead? I mean, if this is not going to get sorted in a hurry, where do you see a major pain, especially coming in for the emerging market currencies then?
Well, like I say, I think if you look at the emerging market currencies as a whole, they've got some dire straits still to come. They've suffered large-scale devaluations. Areas like the Indian rupee, yes, we are expecting further devaluations, but really, I think there is a limited downside, I'd say. I think with the Indian rupee, it's particularly interesting because we've finally broken above that range, above the 64.50 levels, currently running into some form of resistance around 66. But I do think we can see this particular one run into around 70. But these kind of devaluations are far smaller than we can expect from others. Brazil, for example, I think the Brazilian real is going to suffer some more downturns as well. Like I say, the Turkish lira, I think, is my biggest concern right now, just because the state of the economy and the lack of preparation really for this, added to the political turmoil, is a massive concern.
Arvind, what's your sense? Because while we have been hearing reports, and as Craig also mentioned, 66 to 70 are the kind of levels that seem to be floating into the market now. Do you see that much of a depreciation left in the Indian rupee, especially just for 2015?
I mean, without trying to go into specific levels, I think rupee does have a lot of weakness going from here. So probably 66.50, 67 definitely looks to be on the cards. But my sense is this is very different from what we saw 2 years back when dollar rupee went beyond 68. Right? That time our fundamentals were much weaker than what we are today. Today the reserves are much better, deficits seem to be in control, inflation is broadly manageable, and even 7% growth is not really bad in a global growth of less than 2%. India at 7% is not bad either. Broadly, there's a lot more confidence on the Indian rupee. There's a lot more interest in the economy. So assuming broad macro factors remain the way they are and there is some help from the policy front, I think there will continue to be interest on India. The RBI has done a damn good job of controlling the currency. So rupee weakness on a runaway basis is something I don't see. But yes, weakness in line with larger emerging markets fundamentals is definitely in the offing. So if you see Indonesia, Malaysia and every other currency depreciating, I don't think Indian rupee will buck the trend, but to me it doesn't look to be an uncontrolled weakness.
Jayesh, the initial thought was that if China doesn't do it so well, India perhaps was the second best destination in the emerging market and we really stood to gain. We were perhaps in a sweet spot, but that really doesn't seem to be working out because there is this risk aversion which is across the asset classes.
Yeah, I think there is risk aversion, but even today with the risk aversion amongst the emerging market, I think India definitely stands out, right? And if you look at investors, they would be very comfortable, right? It's on a longer term basis, they would be very comfortable. On a medium term basis, yeah, can it go to 68? It can if China devalues further and stuff like that. But I think 66.5 is what a lot of guys would be comfortable. So if we breach that, we actually might see new investors coming unless there is something further murkier in the world. But it doesn't look like. So from that perspective, yes, people do feel that it can breach, it may touch because of further devaluation in China. I would not really look at other emerging market. Yes, it has been affected like Malaysia and Indonesia, but I think they have their own other problems too, right? So it's not only, so I wouldn't be too much worried about that, but yes, definitely China is the only thing I would look at this juncture. If China stabilizes, but that, how do you get that comfort? Like, how will you know that, okay, that was one time and it's just not going to get repeated? And that's what is worrying on people's mind. And as I said, like, it's a small demand is moving up the price, right? Of course, we have the other side supply too. I think there has been large OFS announced. It was just in media after the market hours. So maybe hopefully that should cool down the market at least next 2 days or so. But let's see how it goes further.
Well, yes, there's too much to watch out for right now in the markets there. Let's get in one more voice. And Ian Stannard, head of European Currency Strategy, Morgan Stanley, now joins us on the phone line as well. Ian, hi, good to have you. What's your sense? Because, you know, there's, for the longest time, we were discussing Fed and Greece was a focal point, and it simply is China. With whatever Greece has done in the past 1 week, markets haven't even paid any heed to that. How long do you think are we going to stay fixated on what China is doing?
Yes, I think we're in a situation now whereby global risk appetite is facing greater challenges. You mentioned before that we had Greece being very much a focal point for markets. That has now slipped, even with the latest developments in Greece with the new elections scheduled for September, which and the disruption that may have to the implementation of reform measures there. The impact from China is likely to have broader and bigger implications for global markets. So I think it is something which the markets are going to look at more intensely and will have a more prolonged impact on financial markets. So we need to watch very carefully the developments there and the spillover effect. We see now that there is a broader spillover effect taking place, as we've seen with regards to not just equity markets in the region, but also globally equity markets coming under pressure. And that could start to have implications insofar as it impacts investor sentiment and results in a position adjustment. And I think we're starting to see some of that being reflected in the broader currency markets at the moment as well. If we look, example, at the euro is now looking very well supported, and we think the euro can go higher. Why is that? That's because we believe the euro has been used as a funding currency, and as cross-border flows slow down as a result of a reduction in risk appetite, that allows the euro to be pushed higher by the supportive commercial inflows into Europe, which are the result of Europe's current account surplus. So without those investment outflows from Europe, without those funding outflows from Europe, the euro would naturally start to move higher. And I think we're starting to see evidence of that. So the euro is likely to push higher, not just against the dollar, but we could see more emphasized gains against the other high beta currencies within the G10, such as the commodity currencies. And we'd also be looking for the euro in the near term to be moving higher against the emerging market currencies, and in particular against Asian regional currencies as well.
Regional currencies really seem to be a concern right now, and doesn't it? Because we've seen all those, termed coins as currency debasement, currency war come back suddenly. Do you see, after 2 weeks of the volatility that we have seen in currencies, especially in emerging markets and Asia, do you think the worst is behind us, or would you say we are still in thick of things here?
I think the market is now looking more closely at these events and more closely at the spillover effects which are taking place. So it's not necessarily the events themselves within China, within Asia, but it's the impact that it's having on global markets. I think is coming under greater scrutiny. So I think the important factor going forward will be to look at the broader performance of asset markets. If we see some stabilization, I think that will provide some renewed comfort. If equity markets do start to find some support at these levels, in many cases we are at quite crucial levels, testing longer-term trends. So I think that's going to be the important thing. If we see some stabilization, yes, I think that will be reflected through into some stabilization in investor sentiment and will allow currency markets to also regain some support. But if that fails to come through, then I think we are going to see some of the higher beta currencies continuing to come under pressure.
Fair point, Aryan. We'll let you go at that. Thank you so much for joining us. So that's the view also coming in from Morgan Stanley, that we still are awaiting for some stronger concrete cues. If there is a stability coming in, that is when perhaps you can take a better call on all of this. But with that, let's go for a short break. When we come back, we'll of course continue with our discussion. And also because of what's happening in Chinese yuan, it has sent shivers down most of the commodities as well, where the crude prices are looking at the longest losing streak since 1986. Welcome back, and we're discussing on how the emerging market currencies have been this week, and of course the Indian rupee, which is trading or rather shut shop and weak at 2-year lows as well. Jayesh, coming to you, what's your sense? Because with the kind of decline that we have seen coming in for the currency, there's a sector which is welcoming the move as it makes exports competitive for us. But at these current levels, at 66, almost there, would you see a panic coming in? Do you see an RBI intervention? Do you think there's a level that they would want to defend?
I don't think our central bank always has been never defining a level. They intervene typically whenever there is volatility or undue volatility. I think, and that's the stance we have seen central bank managing it since years. And from that perspective, I don't think there is a target level in mind. If yes, there is sudden sharp move, you do see some Indian banks selling heavily. And that would continue. So that would be, I would say, more like speed breakers, but there is not really a wall which is being created that this is a dead wall and, it doesn't go beyond that. So I don't think that's the kind of stand they have it. Having said that, from a market forces and market perspective, I think till the Fed hike, volatility is going to remain, because we don't know if China does one more round before the Fed hike. And that's the fear people will continue having in their mind, whether there's one more round happening before the Fed hike, and that's something people will be watchful. So, in fact, we will have to live with the volatility, and I think it's for the time being, that's the way it will be.
Arvind, most international bankers are working with another 5 to even a 10% decline coming in for yuan before it stabilizes. What would that mean for India?
Look, a further 5% devaluation on the yuan from here could easily take dollar rupee closer to 70 levels, and honestly speaking, it's not impossible. China is going through a slowdown. The economy needs all kinds of support, and in times like these, domestic policy mandates will trump all international outcry or outrage and so on. So if it's needed, China, which has already depreciated by close to 4 to 5%, will not hesitate to depreciate further as the need comes up, and that would definitely mean mayhem for most emerging market countries across the world, including India. So yeah, 70 doesn't look that far if it's a 5% depreciation on the yuan.
So the concerns in emerging markets far from over. Jayesh and Arvind, we'll let you go at that. Thank you so much for joining us and giving us a sense on rupee and of course the emerging markets as well. With that, let's get one more voice, and Divya Devesh, Asia Forex Strategist, Stannard Chartered Bank, now joins us on a phone line. Divya, hi. What's your sense now really coming in for the currency? Where do you see the rupee headed in the near term?
So in terms of our forecast trajectory, we are still looking for 65.75 for the end of Q3 at a September end, and 65 by the end of the year. But clearly in the very near term, we think that we can overshoot that. 66 is obviously a very critical level for dollar INR, which I think there might be some resistance from the central bank at that particular level. But again, I do not expect them to draw a line in the sand. It's probably going to be more about trying to manage volatility and trying to make sure that this move higher in the very near term is not very volatile. So as long as that is ensured, if we continue to see a weak sentiment globally and a broad move higher for dollar against Asian currencies, I do not think that dollar INR will be left out. Yes, India's fundamentals are quite positive and probably one of the most positive for amongst EM currencies. But despite that, I don't think the INR will be completely insulated from these moves. So a test of 66 and beyond that, a 66.50 is quite possible for dollar INR. But I think it's important to stress that at this point of time, markets are clearly quite dislocated in terms of fundamentals. So it's being driven more by sentiment rather than fundamentals. So once there is some degree of calm in markets returning in the next couple of weeks, we think dollar INR will come back to levels on the 65 handle.
Fair point that. So 65 to 66 of a range coming in there. But Divya, the currency wars in emerging markets, do you expect them to last longer? And what ramification and impact of that would come on the currency?
Sure. Again, I think we have a slightly different view here. We do not think that what China did was trying to actively engage in currency wars. That was more of an issue with their IMF SDR basket inclusion, and not particularly just a devaluation of the currency to help their exports. So we do not think that this is this move higher in EM currencies. Dollar versus EM is a result of currency wars. In fact, this is probably being driven more by weak sentiment and weak data, and the implications are being seen on EM currencies rather than an explicit policy guidance towards weakening the currencies. And again, this is something which Dr. Rajan talked about it yesterday as well, highlighting that the extent of Yuan devaluation so far is not really a cause of concern for India so far, as long as it does not extend. And so far, it does seem that dollar CNY has stabilized at around the 640 kind of level. So we do not think that there's a very active currency war going on in Asia.
Divya Devesh, thank you so much for joining us. So that really is the view coming in from there as well, from Stannard Chartered Bank, that in the near term, yes, the momentum is still on the lower side coming in for the currency. But remember, the sell-off in currencies has had its impact on commodities as well, and the crude prices are putting a longest losing streak, 8 weeks of loss since the biggest since 1998. Let's get in a view then from Miswin Mahesh, oil analyst at Barclays. Miswin, hi, what's your sense now for the crude oil prices and how far are we headed?
For crude oil, it's the ongoing correction phase, partly driven by the fact that the surplus is very much there and expanding. We were roughly at 1 million barrels per day of a surplus when OPEC decided not to cut in November. And that's expanded to 2.5, 3 million barrels per day at the moment. And that's weighing on global crude prices, whether it be WTI, Brent, or even crude traded in the Asian market. That's essentially the reason, and the triggers essentially are also coming from macro elements such as China, the US Fed hike, etc.
Miswin, we'll let you go at that. That's the view really coming in from Barclays then, that further decline in the crude oil price is not ruled out as well. This week, of course, has seen nearly 4% of a cut coming in for those prices. But with that, it's a complete wrap on hot commodities. Thank you for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.